Hello, everyone, and welcome back to the last live show on Open Exchange TV this year. We welcome you back to viewing. And listen, it's always nice to wrap up the year with Jay Pawlowski. How are you, Jay?
I'm good, Scott. But wow, we've got the last show of the year. That's pretty awesome. I am wearing my Santa sweater though, so I am correctly clothed, I guess.
You look very, very festive, unlike me, who's sitting here in a black golf shirt.
But your lighting today makes you look like Carrie Lake. I mean, you've got the soft filter going.
I'm actually doing it from home upstairs today, and I don't have the usual wonderful lighting in the office. So it's actually I've done a couple other shows this week with it as well. So I'll fine tune it next week while we're taking a few days off.
There you go. There you go. Well, I mean, my red sweater does remind me of one of the things I never fully understood, right? So, back in the day playing football for Duke, we had a coach named Red Wilson. He was our head coach. And our slogan one year was Red means go. And I was like, what is that? So it's not really a surprise that we did not have a winning record that year. Nothing against Red Wilson, is a great guy, but when your slogan is "Red means go," I don't know where you really go with that. But anyway, sorry, not to digress. We're going to talk about other things today, I'm sure.
Yeah, it's like I've had a quick look at your musings today. Like you're going way back. Like I've heard of the two-step, whether it be dancing, whether in football, all this sort of side of football. I know a little bit more about it. Maybe you're a little bit light on your feet, Jane. You've got some dance moves you want to talk about, but the old Wall Street two-step, I don't know what that is.
Yeah, well, I mean, I think I might have somewhat created it out of thin cloth, but it just struck me as I was again thinking over the last couple of days. What was the hook? When you write every week, it sometimes can be a bit of a challenge, but we like challenges here at TPW Advisory, so we embrace it. And what came to mind last night, today, was the idea of the two-step, right? And it's the old dance move where you've got a couple of steps. And it struck me that this year we've had a year where we've had multiple, kind of 2-month periods where markets were either up big or down big, right? Think about August and September, just horrible months, followed by October and November, which were great months. You think about the idea of December is supposedly, statistically anyway, the best month of the year in terms of being up percentage-wise over history. And look, where are we today, right? We're going to, unless next week is just a blow-off move to the top, December is going to be a lousy month. And then you think about even this week, and it struck me with the data flow, right? We had Q3 GDP being better than expected, Q4 nowcast talking about near 3% growth. And so, okay, the Fed is going to have to raise rates even more aggressively. Then we get the leading economic indicator yesterday, one of the worst we've had in a year. Okay, so all of a sudden we're going to have recession. So the market just kind of the old two-step back and forth. And then I kind of wrapped up my thinking with the 60-40 portfolio, somewhat of a two-step, right? Two different assets, thinking that your typically works reasonably well. They hedge each other a little bit. And of course, as we know, in the meat grinder of 2022, neither worked. Both have been down big, the worst years. So the worst year for the 60-40, I think pretty much in history. And then it begs the question, to wrap up at least our first segment here, will we get the Santa Claus rally, right? And will the market be down 2 years in a row? History suggests down 2 years in a row is quite unusual, but we've been in an ahistorical period, something we've really focused on here at TPW Advisory. History has not been a good guide for at least 2022. Now, our view, as you may recall, Scott, because you have a pretty good memory and we talked about it, our view is that stability is going to manifest as we move through 2023. The headwinds of 2022 become the tailwinds of 2023. And so therefore history probably starts to play more of its traditional role in a more stable environment next year. So perhaps we don't get 2 down years in a row, and perhaps we do get the Santa Claus rally, which according to All-Star charts begins today and extends through January 4th. And again, very much in keeping with the two-step, the real key is whether or not Santa shows up. Because when Santa doesn't show up, then that next year, 2023 in this case, tends to be a pretty, unimpressive year, averages a 5% return. Now, when Santa does show up, that next year averages a 10% return. So that's pretty, that's worth stakes worth playing for. So that's maybe a slightly long-winded answer to what does the old Wall Street two-step mean.
Well, hopefully Santa's not, if he does turn up, he doesn't come up with a lump of coal.
All the coal is being burned in Europe this year to keep Europeans warm, right? So,
well, it's funny you bring up Europe. Like, does like this whole two-step thing, like, does it roll over globally, or is this just for the US?
No, it's interesting, right? Because as I thought it through, it extended to the rest of the world, and I actually start in Asia. We'll start in Asia as the Musings does, and then we'll finish with Europe. So actually, Asia to us has been impressive in that the pace of change has really accelerated in Asia over the last month or so. And so for investors who are watching us now and listening, you really need to focus in on Asia because zero COVID, right? Perfect example of the two-step. Zero COVID, boom, no more zero COVID, right? And that happened in the last month, and it was a good 4 or 5 months ahead of the most bullish people on Wall Street, which was Goldman Sachs in this instance. They were calling for zero COVID to be removed in April of 2023. And here it is in November, December, and it's gone. All right. So that is a big, big change. And when I read Morgan Stanley calling for 5%, almost 5.5% GDP growth next year in China, led by private consumption, growing at 8% versus less than 1% this year. We're talking about a sea change, right, for the global economy. And as you know, we have been pretty steadfast arguing that we're not going into a global recession next year. And the fact that China has done the old two-step and pivoted away from zero COVID 4 or 5 months before the most optimistic people on Wall Street expected, that's a real plus for global growth in our view. And then you go to Japan just in the last week. Again, the old two-step, yield curve control in this case, right? The Bank of Japan's policy that's been in place for almost a decade or so. Yield curve control, no change. Boom, yield curve control is flexed so we can fix, so to speak, the JGB bond market. To us, this is also a big step. And much like China, where we think the true reopening will be seen around the Chinese New Year, which extends late January, early February, we think the true two-step in Japan will be in the spring when Bank of Japan Governor Kuroda steps down and a new governor comes in. We think the move over the last couple of weeks will make it easier for the new governor to enact a change, which we think is going to be kind of similar to what we've seen in the U.S. and Europe this year, the beginning of a bond bear market in Japan, right? Because inflation, again, kind of funny two-step. The Fed is slowing its rate hike pace because inflation is falling. Japan is starting its rate adjustment because inflation has risen, right? So this is where the old macro game becomes interesting. It's actually quite bullish for Japan to finally have inflation above 2%. They've been trying to do it for 20 years. It's finally happened. And so we make the case that while everyone else is talking about what this means for the yen carry trade, we're making the case at TPW Advisory that the real key is that we're going to shift from a bond bull market to a bear market and perhaps a bull market in Japanese equities. And so we talk, you probably are too young to remember this, but we talk about the famous Mrs. Watanabe, who was the stock buyer, the kind of the avatar for retail stock buying in Japan back in the 90s when Japan was the global story of note. We think Mrs. Watanabe, who's been buying bonds for the last 10 or 15 years, backstopped by the BOJ, we think she may make, or maybe her daughter may make, a return appearance, and you'll have both domestic and foreign investors looking to buy Japanese equity. So that's something we're pretty keen on. And then finally, just to wrap up, because you asked about Europe, and we should touch on Europe. In Europe, the same thing, right? We had all the worries about natural gas price shortages and, lack of power. And the story was going around the summer and fall about Europeans huddling by candlelight because power was off, because there was no energy supply. And what happened? The old two-step. Natural gas prices have collapsed, down 40% month to date, down close to 70% from their peak. And so Europe is doing fine. The economy is doing better than expected. And lo and behold, Europe is the best performing equity region in the world this quarter. So, go figure, the old two-step.
Actually, I just had a question come in from one of the audience here. We don't really talk about Latin America very much. And the question is, what about Argentina? So that's obviously a little bit more specific. But any windfalls from Messi's heroics? I don't know about that.
Yeah.
What about Latin?
The Argentines are celebrating the two-step on the soccer pitch, right? And as well they should. And it's a great success. And it's great to see Messi kind of go off, with winning the World Cup. And Mbappe, kind of the clear global successor, right? Getting a hat trick. Just impressive. I mean, I'm more of an American football. I know you're an Aussie football guy. So, we're global here. But, we can all appreciate wonderful athleticism. And we saw a lot of that in the World Cup. But unfortunately, I don't think it extends to financial markets for Argentina. Where we pay attention really in Latin America is in Brazil. And that's a market that we've liked for some time. It's been one of the better performing markets year to date. Has had a pretty aggressive pullback as people worry about the new Lula government and what they may do policy-wise. But if we're correct, and places like firms like Morgan Stanley are correct, that China is going to grow at 5.5% next year from, call it 2.5% this year, so a doubling of China's growth rate, that should be pretty constructive for commodities and for Brazil in particular, which is a big exporter across the commodity space, from ag to energy to minerals, Valley, the beef companies, the soy companies, Petrobras, the oil companies, etc. Brazil's a big winner from that. And so Brazil's also, we believe, a big winner in an important theme of ours, which is the shift from rate hike cycle, which we had in 2022, to a rate cutting cycle, which we believe emerging market central banks are going to lead once the Fed goes on pause, which we think will be in the first quarter of next year. And Brazil is one of the leading candidates to lead that emerging market rate cutting cycle. Inflation running about 8-9%, short-term government debt at over 13%, some of the highest real rates in the world in Brazil. And so we think that's we're going to see rate cuts out of Brazil, and we think that's going to support the domestic equity market. So that's where we have a decent bet, overweight Brazil. That's really our play in Latin America.
Okay. Well, let's listen. 2022 has been a rough year for markets. It's been it seems like we came out of COVID, but COVID's like rearing its head. Like if you're around the Northeast, everyone seems to be sick, whether it be COVID, flu, RSV, whatever it is. So let's be done with 2022. Let's take a look at 2023. What are the keys for this to be a successful 2023?
Well, we focused, as we have since June, on our three keys for what we call then the second half, and we're carrying that right through into 2023. right? The pace of U.S. Inflation's decline, the path of European energy prices, and China's ability to move off zero COVID. Those were our three keys, and they've stood us in really very good stead in the second half of the year. And we think they will continue to be important markers for us. And so as we touched on it a minute ago, we expect the Fed to go from being one of the most hawkish central banks to one of the least hawkish, right? ECB is going to raise rates more than the Fed next year. Bank of Japan is going to be moving more aggressively than the Fed next year. So we think that means dollar weakness will continue, which is a big theme of ours. Again, we've been talking about this for several months. We think dollar weakness is setting up the opportunity for the non-US equity markets to outperform. And I would note that I talked about it a minute ago, Europe, by far the best performing region in the world quarter to date, up about 15 to 18%, whereas the US is up only a couple of percent. I mean, a big move on a relative basis. And then year to date, if you add in Japan to Europe and look at EFA, the developed markets, ex-EM, EFA is outperforming the US by about 400 basis points year to date. Okay. And so EM has been lagging in part because of China, in part because of just the general uncertainty. EM is a risk on trade. People haven't wanted to take risk in the meat grinder of 22. But we think, as we've said, we're setting up for EM as well. We talked about Brazil. We've discussed China. We like China. We like Southeast Asia. We like emerging market local currency debt. We like Asian high yield. We have 5 or 6 positions in our global multi-asset model that are directly focused on EM across the space, debt, equity, and currency. And we think they're all going to do pretty well. And so our view is that 2023 will be a flattish type year for the S&P, which we think, combined with the weak dollar, is a very good environment for non-US equity. As we touched on over the last couple of weeks, right? When the US goes up, nobody cares about any place else. When the US goes down, everything goes down. So you need to thread the needle. In our view, things are setting up for that needle to be threaded, where we think we're going to have a very significant global asset allocation sea change away from the US. The US has been the only game since the bottom in 2009. You look at any metric, fund flows, valuation, performance, US has dominated. But now it's extended, again, on any metric. And so we think that that 2022, the end here, which we just talked about, 2023 and going forward, is going to be a period of non-US equity outperformance, both both developed and emerging. And our focus has been on Europe, and we've talked about it a lot. A lot of people beat us up this year because of our view of Europe. And lo and behold, Q4, massive outperformer year to date, roughly in line with the US. We think 2023, the story in the developed markets could be Japan, as we touched on. Both domestic and foreign investors going into Japanese equity after a decade or more, where the domestic investor exited and the foreign investor has just not had to pay any attention at all. Japan used to be a big market in ACWI, right? All country world. It used to be, I forget the peak, but probably 20, 30% or more of ACWI. Now it's like 4%. The US is 62%. We expect those numbers to change pretty meaningfully over the next couple of years. So that's really our big bet. We see a flattish S&P. We see a weak dollar. We see conditions really ripe for non-US equity to outperform, both developed and emerging, looking at Japan as the surprise performer next year, like Brazil, like China, like Southeast Asia, in the emerging markets. So I think it will be a better year, Scott.
I hope so, Jay, because I'd rather smiley, happy people dealing with the markets rather than seems like everyone's depressed right now about the markets, especially as you've got layoffs coming and all that sort of side of it, and people aren't getting their rosy Christmas bonuses like they used to. But no, listen, Jay, thank you so much for everything you've given us this year and your insights. Have a great Christmas. Good luck with Duke with their bowl game next week.
Yeah, we're going. Boys and I are going. We're excited.
It's fantastic. Where is the game?
It's in Annapolis. We're playing the University of Central Florida, which is a pretty impressive team, 9-4 record. So we're excited. We had a chance to speak with the coach last night. Our little group of gridiron group at Duke. Coach is excited. Had a good recruiting class. We've been able to retain our players in terms of portal activity. And, they're fired up for the bowl. It's the first bowl for Duke in about 5 years. And so my boys and I are heading down, and we're looking forward to notching that 9th victory for Duke.
Well, good luck with that. I actually love, like, Stu Semonite. He does so much great work in the background for us, putting a little lower third there on you. It's what, Duke 77-81? Is that what it was?
That's what it was. Yes, indeed. Red means go.
Listen, once again, thanks so much, Jay. Have a great Christmas, and we'll be talking to you in the new year.
All right, Scott. All the best to you and your family and the whole team. Thank you.
Thanks very much. And for everyone out there, Merry Christmas, Happy Holidays, whatever you celebrate. We'll be speaking to you in 2023. Until next time, good luck investing.